Hey everyone, thanks for tuning in to another weekly market story where we explain a timely financial concept in 3 simple slides. I'm Dan Stous, lead wealth advisor here at Flagstone Financial Management, and this week we'll be talking a little more about concepts related to new market highs. As you may already know, especially if you follow us on social or you subscribe to our emails, the S&P 500 recently has hit new all-time highs, crossing the 5,000 mark just a few years after crossing the 4,000 mark. Now, as we mentioned a couple of weeks ago, that's positive news, right? If you're an investor in the stock market, that means you made money, unless you're betting on the stock market to decline. You should continue to focus on the long run, like we explained a couple of weeks ago, but you should also have an awareness of maintaining diversification and managing risk in your portfolio. In other words, don't let the market highs cause you to get greedy, pursue even higher returns while ignoring the potential for markets to decline. Because we know the stock market volatility is inevitable, and how we react to market swings can matter just as much as maintaining that long-term perspective. So what does that all mean? Why does it matter? How does it impact your investment decisions? We'll talk about that over the next couple of minutes. First, this chart shows the break-even returns needed to recoup a certain loss. So for example, a 10% loss shown there on the second set of bars there would require an 11.1% gain to make up the difference and arrive back at break-even. Now, for some, this may seem odd at first, but it's just based on the way percentages are calculated. So example, take a look at the bars for a 50% loss. It's the third one from the right there. A 50% loss means you've lost half the value of something. So in order to get back the original full value, you need 100% gain. And that makes sense intuitively, and it's just how investment returns operate. The problem is that investors may find it daunting to have to gain 25% or 43% or 67 or 100% to recoup their losses. So when losses do happen, and they're nearly inevitable, in the worst case, investors may give up on the investing plan altogether. So the point here is twofold. First, don't invest in a portfolio that's too aggressive for you, where a big loss would cause you to give up. And the second point is that markets do tend to rebound. It just takes a little higher return to offset the loss. Now, before we get to the next slide, it's important to bring up a concept called loss aversion. Loss aversion is simply the idea that losses hurt more than gains feel good. Here's an example. So when I was wrapping Christmas gifts just a couple of months ago, I lost a $50 gift card, and it made me sick to my stomach. I looked for it for days. I kept thinking about what I could have done differently to avoid losing the gift card. It was awful. In fact, I still feel a little bit of negative emotions towards it. Fast forward a few weeks to our holiday office party. We played some prizes for cash winnings, and I actually won. And in fact, I won more than $50. And I was happy. I was excited for sure. But the magnitude of my happiness wasn't as strong as the magnitude of the sadness when I lost that gift card. That's loss aversion. The losses hurt more than the gains feel good. And it's true with investing. It's true with investment returns, just as it was true with my gift card and cash prize example. So it's important to create a portfolio that's mindful of loss aversion. So let's take a look at the next slide. This chart shows how an all-stock portfolio performed since 2008 compared to a very conservative all-bond portfolio, compared to more diversified portfolios of some stocks and some bonds over the same time period. Loss aversion was happening in 2020, for example, when markets were down quite a bit, and the greater the losses, the worse the loss aversion actually feels. In the extreme, investors may even give up on investing when they hit large enough losses, and we know that to be true in 2020, 2022, 2008. We actually saw that happening. So here's the takeaway from this chart. It's important to stay diversified to have a smoother ride, especially for older or retired clients who are relying on their portfolio for living expenses. Now, while the all stock portfolio would have generated the best returns over that time period, few investors have the stomach for that level of swings, and particularly like the retired clients. Like I said, if you're younger, you can usually withstand those portfolio swings because you're not going to need that money for a while. But if we've established that it's best for you to have, as an example, like 60% in the stock market and 40% in the bond market, it's a good idea to stick with that for now, as opposed to getting more aggressive, simply because it feels like the stock market is on such a tear and you want to ride that to the top. Finally, the sequence of returns matters as well. What does that mean? It's whether investors experience good or bad markets first, meaning when you first retire, for example, when you first start taking money out of your portfolio. So when investors experience bear market first, they may be tempted to give up altogether. Additionally, the math of investing works out such that withdrawals from these portfolios don't have the benefit of compound interest, which lowers the final portfolio values. In other words, if you're an early retiree, pulling out a large chunk of money from your portfolio during a down market is more harmful than if you were, say, 6 years into retirement. So why is all this important? Well, it's critical that you have an appropriate portfolio for the season of life that you're in, for your financial goals, and for your appetite for risk. Don't let the big bear markets or the big bull markets and the negative or positive feelings that come from those impact your investment decisions. So I'm going to summarize here. Let's be mindful of how it takes larger gains to offset losses. So let us help you manage the risk in your portfolio if you're a client. Second, be aware of loss aversion. The losses hurt more than the gains feel good. And that can cause investors to act irrationally and do irreversible harm to the portfolio. And third, know that the timing of your withdrawals can impact your long-term results as well. If you're a Flagstone client, if you're ever feeling concerns or like you need to make an investment change, talk to us. We love having those conversations with our clients to help you think through different alternatives. Talk with us about changes. We love hearing investment questions or concerns and just helping you decide what's best for your long-term financial future. We hope you found these insights to be helpful. If you wanted to talk about these in any more detail, reach out to us. We'd love to talk with you, and thanks for watching.